This is the Real Estate Investing 365 podcast, your go-to source for real estate investing strategies so you can start living the life you want and get where you want to go. With your host, Justin Hanna.
Hey everybody, welcome back to another episode, Real Estate Investing 365. Today I have with me Travis Watts. He is a full-time passive investor, director of investor relations with Ashcroft Capital. He used to own a bunch of rentals himself and then kind of moved out of the active game and just does the passive syndication model. Hey Travis, thanks for being here.
Hey, thanks so much for having me, Justin.
Yeah, absolutely. Why don't you go ahead and start off by telling us a little bit about where you come from and how you got started in real estate to begin with, and then we'll move on to where you're at now.
Sure, yeah. So I guess we could start the story before the last downturn. My dad coincidentally got me a book. I think it was from a garage sale, and it was Rich Dad Prophecy. A lot of people get started with Rich Dad, Poor Dad. You hear that all the time. So this was Rich Dad Prophecy, and the bottom line after reading that book, totally out of the blue, was that we're going to have this market meltdown. Don't know exactly when, but it's coming, right? It's the big doom and gloom fear thing. At the time, 100% of my assets, which wasn't very much, was in the stock market. Mm-hmm. So all I really got from that book was you might want to think about not being in the stock market.
Yeah.
And so, and then of course, it's Robert Kiyosaki. So there's elements of real estate and cash flow and stuff embedded throughout the book as well. So it kind of opened my mind a little bit. And so long story short, I ended up selling in about 2007-ish, 2006, 2007. And I was just literally sitting in cash. I didn't know what to do with it. I wasn't ready to jump into real estate yet. I was out in Florida at the time, and I was preemptively kind of planning a move out to Colorado. So I didn't want to buy anything there or invest there or in Colorado. And so, I set out the downturn, which was completely coincidental. I mean, I guess you could contribute some of that to the book, but I mean, it was really just dumb luck.
Yeah.
And yes, that's what happened. And so, simultaneously, I'd been working since age 15. I save a lot of my money. I've always been kind of a budgeter and, pretty diligent with finance. And so 2009 rolls around, and now I'm kind of ready. I'm in Colorado and kind of looking to get started in real estate. And now it made more sense than ever. And 2009 was an interesting year because the government was giving out the first time home buyer credits of $8,000 if it was your first home. And in previous years, you'd had to pay that back. But in 2009, you got to keep all of it. Mm-hmm. So I bought my first home in 2009, owner occupied home, got the $8,000 tax credit, used all my savings and funds that I had saved from that downturn. Yeah. And that's how I got started. 2-bed, 1-bath, $95,000 property, conventional loan, that kind of thing. And started doing some house hacking over time, had a roommate, had it all fully furnished and rented. And that's kind of where the real concept of passive income and cash flow really started to resonate with me. Started to see that without me having to do any work, my mortgage was just about paid. Right. By somebody else paying rent. And I thought, holy cow, that's a path I want to pursue. I want to learn more strategies around that. Didn't know what I wanted to do, long-term, but knew that was of interest. So from there, it just kind of built. I got into some fix and flips and some buy and hold single family, house hacking strategies, and just kind of built onto itself into a single family portfolio. And so back then, I had a pretty small network. And I guess my biggest influencer would be my dad and stepmom. They didn't get into real estate, specifically single family, until he was in his 50s. So kind of later in life, but all of a sudden I started to kind of see that cash flow start kicking in, right, as he's setting up for retirement. And it just made such an astounding impact on the bottom line. And I thought, man, I ought to take the same path. What if I took it, this many years earlier? And so I started going down the single family path, built up a portfolio, maybe had, 5 to 7 properties at any given time. And at the time I was a W-2 employee. And not only that, I was working 100-hour work weeks in the oil industry away from home, trying to also self-manage that entire portfolio, which was getting more and more active and taking more and more of my time. And I just kind of hit a breaking point where I said, this portfolio isn't scalable like I want it to be. How am I going to get to 50 homes or 100 homes if 7 is knocking my socks off? I can't even handle that. And that was kind of my big breakthrough. Kind of went back to the drawing board and thought, how do I become completely passive in real estate? I love real estate. I love cash flow. I love the asset class, but I don't want to be hands-on. I don't want to manage tenants. I don't want to manage asset managers. I don't want to be, filing and saving my receipts and losing track of crap and dealing with, CPAs and all. I just want it to be simple, and I just want to be involved. And so that's where I learned about syndications. Specific to multifamily syndications. It seemed honestly too good to be true when I found out about it. I mean, I was in some real estate groups, listening to podcasts, reading books. I kept hearing the word syndication, and it was like you could be completely hands-off, completely passive, still get all the benefits of depreciation and tax benefits and cash flow. And I thought, man, there's no way. So I tried one syndication locally. I was just partnered up with a local group. I thought that was the way to go, local, because I could be face to face and meet up with them. And just kind of sat back for 6 months and watched that investment kind of unfold, right? Monthly distributions, monthly reporting. And honestly, about 6 months in, I fell in love with the model. I thought that is the model that resonates 100% with me and what I'm trying to achieve and my long-term goals. So long story short, I sold all of my single family portfolio. I went 100% into syndications starting around 2015 or so, and over the next few years. And so fast forward through today, and I think maybe 26 deals we've done among 14 different groups between my wife and I. And we're just 100% passive, limited partners and apartment syndications mostly.
Cool. No, that's awesome. And it's been around for obviously a long time. Syndicating apartment deals have been around for a long time, but it's really gaining traction and on both ends of people wanting to be general partners and do the syndicating themselves. Everybody seems to have a syndication now. And then also limited partners. And myself, I just got into my first actually Ashcroft deal. It's about to close, I think, in the next week. I think it'll close before this episode comes out, but so that's cool. So what year was this that you kind of started hearing about syndications?
Yeah, somewhere around 2015. I may have heard about it previously, but wasn't ready to take action on it. So 2015 is when I actually started investing in syndications. Did hear about Ashcroft. They were probably my fourth, fifth investment, somewhere around there. I've been investing with them roughly 4 years, and met up with Joe Fairless. If your listeners aren't familiar, Joe's also got a podcast and does the best ever conferences every year. He's an author and speaker and co-founder of Ashcroft. So I ended up doing one deal with them, and it just completely aligned with what I was looking for. I was looking for monthly reporting, monthly distributions. The numbers aligned with what made sense to me. They were in the markets I was looking in. It was one of those things. And fast forward to today, I'm in 9 of their deals today. And, but they're just one of the groups that I've worked with. So I'm part of their investor relations team as well. And so that was something that came about also over the course of time, which I'm very grateful to have that opportunity as well.
Yeah, no, that's awesome. That's a good way to learn the business and stay in touch with the best deals, I guess, is get in there and be part of the team.
Exactly. What better way, right?
Yeah, that's right. So back to your single family properties and stuff. Were they all single family houses, or were there some duplex or fourplexes in there? What kind of?
It's funny. I never pursued the small multifamily. They were all between, condos, townhomes, single family residence. And other than that, the house hacking stuff was, I bought a couple places a bit bigger, like a 4-bedroom house, and had a couple roommates here and there, but never got into duplex and quads, things like that. Nope.
Okay. I understand. So what was was just the driving point to get away from the single family and even hiring out property managers? Was it just that you wanted more free time? You just didn't want any hands-on. You just wanted strictly a better than the stock market, but less hassle than running your own properties?
So I think deep down, what I always really wanted was just the passive income. I mean, that's all I really wanted at the end of the day. And as I started getting more hands-on with having to manage every element of my own portfolio and my own deals, I just realized, quite frankly, I wasn't that good at it. There's people out there doing it way better than me. And I thought, and not only that, I don't have time to dedicate to this. I don't want to dedicate time to this, running out and changing a sprinkler head or something on my weekend. Like, I don't want any part of that. I want the cash flow,
Yeah.
but I want to be able to focus on what I want to focus on, no matter what that means at the time. It evolves and it changes, but I just don't want to be tied down with a portfolio like that to self-manage.
Right. Okay. So, what kind of returns do you look for in the syndication model? Because
Mhm.
can you compare it to the returns that you were getting in single family, or like what's your criteria that you look for?
Yeah, exactly. I was never much of an equity investor. Okay. I was never much of I'm going to buy this single family home and in 5 years it's going to be worth blah, blah, blah. I strictly was looking at it from a cash flow standpoint. If I buy
Mhm.
it for this price, how much rent can I get? How much cash flow does that equate to? So, and I still look at deals the same way. So I'll see a syndication. And I'll say, well, 7 to 10% cash flow, over the hold period, and then maybe a potential of blah, blah, blah in 5 years. Maybe that's there. Maybe that's not. Maybe they hit those numbers. Maybe they don't. To me, honestly, it doesn't matter. I'm looking at the cash flow because that's my income and that's what I'm most concerned about. And if you look back at multifamily and how that's performed in recessions and downturns, and in a lot of cases, you can bank on the cash flow at least being there through a lot of those downturns with the right debt structure and the right team and experience and all that too. But it's a little different in single family because you're basing the valuations off of comps, comparable sales in the area of that house, whereas multifamily is primarily based off the net operating income. So as long as you've got occupancy and people, paying rent, and by the way, what I invest in is value add B class, sometimes C class properties. So we're talking about workforce housing. We're talking about like just middle of the road, if not a little less in rents. So there's a high demand for that, both in people wanting to buy it and people needing to rent it. There's not a lot
Mhm.
of options out there for renters. So when you talk about a recession, I mean, it's a very demanded asset class to be in.
Yeah.
Looking forward to that. Yeah.
Yeah, no, definitely. And I like that asset class too, because you always think if a recession does hit, right? Like the brand new luxury apartments that people are living in. Well, if they get hurt, they're going to be moving down to like the B plus market, and the B plus people are going to move down to the C or B minus. It's just going to trickle down. But if you're in the C plus to B minus area,
Hmm.
you seem to always be pretty safe. You know what I mean? Like, because people
Yeah.
still need a place to live either way.
Both statistically and in theory.
In theory, yeah, that's true. And as people are getting older, right, the age demographic, people are getting older, they're downsizing, they want to lower their expenses instead of raise them. So
Yep.
that market kind of is good. And younger people, right, they're moving out. They're not going to move most of the time into a $2,500 a month 1 bedroom apartment. Although I did live in a $2,500 a month apartment, but that's because it was all I had to rent in the Bay Area, California. So
Yep.
I wish I owned that building back then, but I didn't. So, okay, cool. So how do you go about vetting or finding apartment syndicators? Like we mentioned, there's so many out there. How do
Hmm.
you, like, how would somebody that's never invested or looked into
Yeah.
syndications, how would they find a syndicator?
Start networking. I mean, that's the biggest thing, right? I mean, there's plenty of online resources that you can go to. So like
Mhm.
forums and whatnot, a bigger pockets or something to that extent, right? Where people are talking about different groups and their experience and has anyone invested with these guys and that kind of stuff. That's fine if you're kind of a homebody and that's your method and, whatever. uh, I tend to like to network in actual face-to-face groups. I'm in plenty of investor groups out of Denver, Colorado, Boulder, Colorado, Orlando, Florida. So I travel around quite a bit. I do a lot of seminars and summits and just networking events. So a lot of it starts with a word of mouth reference, right? I'll be talking to someone and it's, hey, you ever heard of this group? No. Oh, well, I've invested in 4 of their deals. It's been great, yada, yada. So it kind of starts with that, a little tip off. And then I'll take it further and I'll do my due diligence. I'll research the group. I'll meet with them. I'll jump on a call, maybe even a Zoom call like this. If I can
Mhm.
meet up face to face with them, I will, maybe at a networking event or one of their events that they're hosting. And Yeah, it starts from there. I usually spend anywhere from maybe 2 months to 6 months kind of in that due diligence phase, kind of doing my homework and background checking. And then from there, if everything checks out, everything aligns, I'll end up doing a deal with a group like that. So,
Okay. And I know we had touched on a minute ago about the return, but
mhm,
what is a returns people should look for, right? Because I know,
mhm,
like, for example, the deal that I just went in with Ashcroft Capital, I think it said there was a 8% return, a preferred,
mhm,
or that's a Class B share, or a Class
mhm,
A share of 10% return, which I guess is an equity partner.
mhm.
So there's a little different. But then other deals I've looked at, they only say a 6% return, and then others people are saying, oh, you have a 12% preferred.
Mhm.
Can you kind of break that down and explain the differences and
Yeah.
why such
Mhm.
high numbers might not be realistic, or might be? I don't know.
There's two things to kind of point out. Some groups out there that I see as specifically new groups out there are aggressively underwriting, right? Pushing the potential rent increases really high, or hey, we're going to buy this property and we're going to raise rents 200 a door in the first 12 months. Stuff like that is it's way too aggressive. You've really got to take your time with this stuff, and you don't want to piss off your residents and have 30% of them drop out of the property. Um, but the other thing is, it really depends on what asset type you're investing in, obviously. So A class, as you mentioned, is like luxury, new build, new construction, high end finishes, high end amenities, 2,500, 3,500 a month rents for small places. Obviously your returns are going to be a bit dwarfed with that, just because of the price point of new construction and things like that. Personally, with my philosophy, I try to look right in the middle of the road at the B class space, and most of what I have in my portfolio is B class, for those reasons.
Okay. And how long are you leaving your money in the deals, and can you take your money out halfway through?
Yeah, great point. Depends on the group, depends on the business plan, depends on the deal. What I see most commonly is a 5-year business plan, specific to like a value add, which is fixing up a property, right? So they go in and they make the purchase. They're incrementally raising rents as they renovate the place, newer gym, added amenities, dog parks, barbecue area, covered carports, fenced in yards, whatever it may be, right? And so each year, $25 rent increase, 25, 25, 25. So over the course of 4 or 5 years, you've raised rents now $100, 150, somewhere in that ballpark, depending. And so that's like a typical 5-year business plan. Then they're going to do a disposition or a sale. Other groups that I've invested with will have kind of that indefinite hold period. We're going to buy it, fix it up, rent it, refinance, try to pull out as much equity as we can with the goal of pulling 100% of what the investors originally put in so we can return capital. And then we're going to continue holding these properties long term just for the cash flow.
Hmm.
So it really depends, and that's why it's good to look inward, realize what your goals are, what resonates best with you, and then find groups to match up with according to that business model.
Okay. Now with Ashcroft Capital, do they kind of do all their deals the same way, like a 5-year plan to sell, or is some of them indefinite holds, or some of them refinances, or what?
Yeah, for the most part. I mean, can never say always or never, and
Right.
but yeah, it's a 5-year business plan for the
Hmm.
most part. It's B class properties. It's going to range from maybe a 200 unit to a 600 unit. That's kind of the sweet spot. And then they specialize in certain markets. Dallas Fort Worth being a big one, and then some submarkets throughout Florida as well. And who knows where the future ends up, but the majority of the deals have happened in those markets.
Okay, cool. So while you're, I guess this is a question a lot of people might ask, is while you're getting the monthly distributions from your investment, do you pay taxes on those monthly distributions, or do you wait till the end to pay your taxes?
Yeah, so this can get pretty complicated. So it's always good to say, I'm not an accountant, I'm not a
Yeah.
CPA, tax advisor, none of that stuff. So definitely seek your own advice here. But the way it generally works is this: you have depreciation when you invest in real estate. Okay, so that's like paper losses. Okay, the IRS allows you to take the valuation of the property minus the land, and then depreciate it over a set period of time. In real terms, what that means is, just to use some simple numbers, if you received, for example, let's say $10,000 for the year in distributions or cash flow, it's likely when you get your K-1 tax form, which is the only tax form you need to worry about in a syndication, which makes it quite convenient and nice, you'll probably see like negative 20,000 as an example. And it's not that you lost any money. It's just that depreciation's flowing through to you as a limited partner, and it's offsetting all of your cash flow that's been distributed to you. So you're actually, in theory, and in most cases, in the 9 deals I've been in, plus all the others, you're not paying any tax until the sale of the property. And when you do a refinance, that's a non-taxable event because the sale didn't occur. You're just pulling out equity from the deal and distributing it back. So it can be very, very lucrative for tax purposes throughout the hold of a syndication, and even single family.
Yeah.
So.
No, definitely. And this might be getting too far into it, but I was just wondering, so if you, in your example, you bring in $10,000 per year and then it shows like a loss of 20,000 because of depreciation so much more. Do you get to roll that over to your other income in your personal life, whether it's a W-2 or business or whatever? Obviously they're different, but.
Right. Good point. And yes, it does get even more complicated from there, but I'll try to keep it simple. So so if you have other gains, let's say, you had some stocks, and you bought them at $10 a share, sold them at 20. Now you've got some taxable gains. You can take that excess from your property, that extra 10,000 of loss, and apply it to offset those gains, other types of passive gains, capital gains, stuff like that. Now, to take it one step further, if you qualify as a real estate professional, which is, you're dedicating the majority of your time towards a professional real estate business, maybe you're a realtor or, broker, or maybe you're just an investor and you have some single family and whatnot. And this is what you do primarily, at least, more than 750 hours a year, I think is what it is. And you're tracking your time and all that. You can actually qualify to take passive losses and offset active income, which is pretty sweet. So if you just had W-2 income, you can actually use those excess losses to offset that. So when you look at some of the moguls out there, the Robert Kiyosaki's, the Donald Trumps, the whoever name you want to throw in the bowl, this is how they're legally able to pay no taxes. Legally, it's not a loophole and it's not circumventing the system. It's just the IRS code. The incentives are you provide housing for others, we give you tax breaks. That's what the IRS is all about. And they're just taking advantage of that to the highest extent to pay no taxes legally and provide housing for others. So yeah, it's definitely possible to do that. But again, check with your CPA and your accountant and things like that.
Yeah, no, it's good. I mean, it's good information just for people to, because I think a lot of people don't know that, if they're investing in a deal like this, do they still get all the same benefits of regular, regular real estate investment? And most of the benefits are still there, and and having, if you're not a real estate professional, having your wife or your spouse or whatever be a real estate professional is key too. Because that's what I do with my wife, because I have a high income job at a utility, and then my wife, she's an agent on the side. But if she wasn't an agent, we wouldn't be able to write off anything because I make more than whatever the limit is for writing off real estate expenses. So one of those ways, have somebody be a real estate professional is definitely a benefit for sure.
It's a great way to point it out too. Yes, if you're married, that's a great commonality with the spouse. One of the partners there is the real estate professional, the other isn't, but you jointly get a benefit from that. The other thing is, not only do you get, quote unquote, the same benefits as, say, single family, in some cases you get more because you're able to justify doing like a cost segregation survey, as an example, something that's pretty costly to do if you had a single family home and you paid a firm to do that. And all they're doing is, you can depreciate real estate over, just 27 and a half years or whatever, minus the land value. But there's certain elements inside of real estate, like ceiling fans or, your carpet and appliances and light fixtures. You can take those items and kind of, segregate those out and then depreciate those items at an accelerated depreciation level. So like over 5 to 7 years instead of 27 and a half, which is going to benefit all the limited partners in the syndication. So you're going to, in a lot of ways, get more tax advantages through a syndication than you would just owning a couple single family homes. You're not going to go fork out $10,000 to do a survey to save you $300,
Right. And that's what I was going to say, is my next little thing was like, when you're doing your own real estate, you might not have a CPA or a tax person that is well versed in that, or you don't have access to the best people because you're only a small player. You know what I mean? But if you can get with these big players like Ashcroft Capital, they have $750 million of real estate now. They have great attorney or CPAs or tax advisors. You know what I mean? So I'm sure you can get more tax advantage, like you said, part of these syndications than single family homes or small time multifamily stuff or whatever.
Yeah, back to what I was saying with the single family. It's like I didn't feel like I was, that great of a player in the space personally. I saw people doing things bigger and better than me. So it's like, why not piggyback off their success? In a lot of cases, I was making more and passively doing nothing physically than I was doing my own active deals. And it's like, are you kidding me? That's why it seemed too good to be true. When I'm looking at the numbers, I'm like, there's no way. But
Yeah. And
but there is
maybe,
a way.
yeah, well, maybe right now too, especially with where the market is, you know what I mean? It's like
Yeah.
in so many markets across the country, it's just like, unless you're really spending a lot of time contacting owners and off market deals and like doing that due diligence to find good properties, it's hard to make good returns right now. You know what I mean? So,
Yeah.
and people are scared that the market's going to crash, you're going to lose your money or whatever, which comes with being a good investor. But at the same time,
Mm-hmm.
it's worth it to just take a little bit of a loss and maybe return, maybe from a 10% to an 8%, but you don't got any headaches, you know?
And the way I look at that is if I have a single family home and let's say it's going to produce 20% a year, income. Well, 10% of that, I look at it like I'm paying myself a salary, right? I'm doing a lot of work myself. So I'm like paying myself 10% to do that work. And then what's left is 10% that the property's producing. That's like a syndication. I would just rather have the 10% and then do nothing,
Yeah.
than have to be active with it. So
Yeah.
just a weird way of looking at it, but
Yeah, for sure. And so I, I want to back up for 1 minute. So earlier I had mentioned that something that this deal with Ashcroft that has Class A shares and Class B shares.
yeah,
Can we, just because I mentioned it, I want to like break it down to the listener
sure.
that
Yeah.
they can understand what that is. So can you explain the difference between a Class A 10% return equity
Mhm.
partner and a Class B lowered preferred return?
Yeah. So basically, a common thing that's come out in our market cycle as cap rates are compressing and yields are slowly trickling down is, hey, I used to be able to make a higher yield, on other investments. I wish I could get that again today, or where can I find deals like that, or whatever. So without a doubt, there's certain investors more focused on cash flow, current yield, monthly income. I mean, that's really what they're after. My dad's an example of that. He's retired. At the end of the day, what's it about? It's about monthly income. He's living on this stuff. He's more interested in the cash flow than he is, 5, 6, 7 years down the road, there might be this equity potential there. Maybe. But, for him, that makes more sense. So what Ashcroft's done is pretty unique. They've, I'm using simple round numbers here, but in a typical capital raise, they're taking like 25% of that capital raise and dedicating that to an A-class equity shareholder, which is still equity, not to be confused with debt or lending or anything. It's not hard money. It's nothing like that. And so you can get on recent projects.
I apologize for keep diving on Ashcroft stuff, but since you've done a lot of deals with them and you are director of investor relations, I figure that would be okay to, talk more about like what they do and what they've been doing. So
Sure. Yeah, absolutely.
okay, cool. So the last thing is when the property is dispositioned and they do sell the property and you get your big chunk of change back, are people able to use a 1031 exchange into another deal or into other properties? Is it the same kind of thing, or are they not able to do that?
Yeah, so you definitely are. So you can do the 1031 method, within multifamily. And for those that aren't aware of why you would do that or what that means, you can essentially defer taxable gains by rolling your funds, your profits, right, your complete proceeds into another like kind type of project, right? And then you kind of carry that cost basis forward. And then assuming you just do a 1031 after a 1031 after a 1031, now you're 100 years old and you pass away, whoever's inheriting that property can potentially take it over with no taxes due, no past cost basis. If it's worth 10 million that day, then they just get 10 million if they sell it. So it's a great estate planning and tax planning strategy to use. I will say this, It's a lot easier to do 1031s in the single family space because you are in complete ownership, in control of your properties, and there's endless amounts of opportunities out there in the single family space to keep rolling into. With a syndication, upon sale or disposition, to your point, there has to be another group out there with a deal that makes sense to you, that you want to participate in, that is also 1031 eligible. And then, you have to keep, it's like an odds game. So the odds of that happening and you being able to do that time and time and time and time again throughout a whole lifetime is slim, in my opinion, that's going to work out for you till the end. But I'm not advocating you should or shouldn't do it. It's one tool that can be used. And yes, syndications are, you can do that within the syndication space.
Yeah, because I guess if you were to do, like, let's say it works out 3 times and you do 3 1031s, and all of a sudden it doesn't, then realistically you could have a bigger tax burden than the money you're going to make in the sale. Yeah,
you're paying all of those back taxes from that first property you never paid them on, that second property you never paid them on, and now the third property. It's possible, you could be, kind of underwater with that. If you had $100,000 in proceeds, you might owe $300,000 in taxes. So I don't do it, but it's an option.
No, I hear you. Cool. No, that makes sense. All right, cool. Well, Travis, where are you headed from here? Like, what's the future goal? Are you just going to continue to invest in more and more syndications? Or are you going to kind of step away or do your own deals? What's the plan for Travis?
Yeah, for now, I think that value add multifamily still makes a lot of sense. As we progress forward, we'll see. We'll see what happens. Do we go into recession, correction? Do we continue in a bull market cycle? So I don't know, 5-10 years down the road, am I going to be 80% in multifamily? Don't know. But for now I am, because it still makes sense. If yields go all the way down to, now I'm getting 3-4% cash flow. No, I'm going to switch it up. I'm going to do something else for a strategy. But I enjoy helping people on their own financial freedom journey, using things I've done and helping implement strategies that way. I'm not an advisor. I don't do that on a paid service type of way. I just enjoy sharing experience. And whether that's fix and flips for you or house hacking or multifamily or ATM investing, I love being in the scene and the networking environment to grow and expand, personally and to give back in that way. Yeah.
Cool. Right on. Well, Travis, I'll move to the next section. Got a couple of questions here. Where do you like to learn about real estate investing or syndications the most? Is it books or seminars or podcasts? What's your go-to way to learn about new things?
I think honestly, the best way is going to live events, because it's twofold. You're going to pay something, $300, $500, $1,000. It depends. So as an exchange, you're most of the time, in my experience, getting like 3, 4, 5, 6 times that value by what you're being taught at the seminar. In addition to that, you get an opportunity to network with hundreds of other people, which, without a doubt, there's going to be a handful doing what you're doing, or that can help you along the way. And to me, a face-to-face referral and a face-to-face networking environment is so much better than just picking up a book. I mean, I love books and I read a lot of them, but at the end of the day, that's my preference. But yeah, podcasts are amazing. YouTube is great. Online forums like Bigger Pockets are great. There's a lot of great resources out there, but to me, it's live events.
Cool. Right on. So what about, is there some sort of software or app that you use in your personal or business life that kind of makes everything a lot easier?
Yeah. So I travel a lot, both personal, business, whatever you want to call it. I use an app called Agoda. I picked that up when I was visiting Thailand. And throughout my whole Thailand stay with my wife, I mean, our average hotel cost using Agoda was like $20 a night. It was incredible, sometimes less. And I think, I can't speak to exactly how they do it or what they do, but I think it's like hotels when they only have 1 or 2 rooms left and it hadn't been rented and it's kind of last minute, they put a huge discount on them and then they affiliate with that app. So like we went to Venice in Italy. We stayed right in the city center for 3 days for like $75 a night. It was just incredible because all the hotels there were like $400 and a night. And then we waited till the last minute and just booked them up through Agoda. So that's a great app if you travel.
Yeah, no, that's a great tip. You can save some money right there for
Yeah.
sure. Cool. What about a social media or influencer that you like to follow that gives good advice, or you can take
Hmm.
what they say
Yeah.
seriously?
Tony Robbins, Anthony
Mhm.
Robbins, going to see another one of his events in March out in California. Great. He doesn't like to be called a motivational speaker, but it gives you such crazy
Yeah.
motivation to take your life to the next level. And it's always great. I've got his CDs and all that. I listen to him about every 5, 6 years, and it's just great stuff. Gary Vaynerchuk's big on the hustle and the grind, and that's kind of my backstory. Just get out there and hustle, just knock it out, just do it. Just quit procrastinating.
Yeah.
And so those two are great influencers for me. Yeah.
Okay. Cool. And where can people find out more about, for one, Travis Watts, and two, Ashcroft Capital and what they do and how to get part of their deals?
Sure. Yeah. I'm out there on a lot of different platforms. You can find me on Bigger Pockets, LinkedIn, Facebook. I think we got an Instagram profile. You can find me at ashcroftcapital.com. And my email is travis@ashcroftcapital.com. You can email me. So always happy to help. Again, I don't charge and I'm not selling anything, but if you just want to network and talk passive income, strategies, goals, happy to connect.
Cool. And if somebody wants to get with Ashcroft Capital, they can go on their site and just click the Invest With Me form, or Invest With Them form or something like that,
You
right?
can do that for sure. Here's a URL to write down, ashcroftcapital.com/passive investor. That's got a free download as well of a passive investor guide. It's got a lot of things that we've just talked about. How do you vet sponsors? How do you vet deals? How do you vet markets, terminology? What is syndication? How it works? All the FAQs. It's like a 20-page document. So free download. That's a great way to connect to, and a good resource for your listeners.
Perfect. Well, Travis, I appreciate it. There's a lot of great information. Hopefully it'll, open somebody's eyes to a different type of investing. It did mine just recently. So I appreciate you being here, man. And hopefully we'll stay in touch and connect again soon.
Awesome, Justin. Thanks so much.
All right. Have a good day.
All right, you too.